Thanks so much for tuning into today's Talking Point. I'm your host, Neeraj Shah, and it's just the perfect time to have the guest that we have on the show today, Gautam Shah of Goldilocks Premium Research. Just when the week is a busy week and a Fed and a BOJ dominated or a central bank dominated week. But the case for the chat for today's conversation is, where does institutional interest lie per se? And is there any derivative or idea that he derives out of the kind of flows that he's seeing in addition to the charts that he sees? Thematic picks amongst the uncertain markets, if it is a good time to do those. And will gold and silver outshine equities in the near term? Viewers would remember that the last time that Gautam was on air, he had spoken about gold in a very favorable fashion. Gautam, great having you. Thanks so much for joining in. And that was an outstanding call, Gautam. I would love to understand from you. We don't start equity conversations with gold, I know, but it was just such a great call. And the fact that it seems to be a big favorable move in a risk-off environment, how do you see the charts there?
Good morning, Neeraj. Well, I guess such are the times. The kind of world that we live in, the kind of geopolitical risks that we are living with every passing day. I think it's always important to keep a tab on gold and silver. And I've been a big bull for, I think, almost 3 or 4 years now, because it looks like a structural uptrend. Then it got into a sort of a range for the last 15 months. But every time there has been a dip on gold towards 1800, it's been such a wonderful buying opportunity. And anything that happens in the world, gold is the first to move up. And once again, given all the geopolitical developments, we are at 2015, and probably this time we will finally break out on the upside past 2070, and my bigger target stays quite high at 2300, 2400. So I'm quite confident that between now and probably the next 6 months, gold and silver could actually beat equity market returns, because I don't see anything significant happening, at least on the indices. There will be pockets in the equity markets that will stand out, but gold and silver clearly is an asset class that you cannot ignore over the next 3 to 6 months.
Well, there, viewers, you have the answer. Should we shut off the conversation now? Because I think Gautam has laid out the key thoughts per se. Look at gold, look at silver, don't look at indices. But okay, Gautam, be that as it may, I just want to bring in the focus now to equity markets. I saw and I read your view on the indices, and by the way, I mean, we've now kind of broken below 19,001 again. Once again, you were of the opinion that the Friday's move was a quote unquote, not quote unquote, but a dead cat bounce. I mean, I'm not quoting you verbatim, but that's the inference that I drew from there. And you believe that 19,200 is the resistance, and we could arguably come off and retest the recent lows. Can you explain that?
Yes, Neeraj, I think I wish I had spoken to you a couple of weeks back, because right from 19,600, 700 levels, we've been maintaining a cautious stroke bearish stance for a while, because we just thought that everything came in together to suggest that the market did top out for the medium term at levels of 20,200. Whether you look at it technically, whether you look at it flows, whether you look at the sentiment, the kind of madness that the market saw at 20,000, the kind of vertical rally that mid caps and small caps had seen, I have not seen such a parabolic move in mid caps and small caps in a very, very long time. I think the last time it happened was probably 2007. And you had an environment wherein large caps, mid caps, small caps all did well at the same time. In the textbooks, it's written that when something like this happens is how you define euphoria. And I think that was really the best way to define euphoria. So I think we've been maintaining a cautious stance. I think this is a classical downtrend that we've got into. We will make a series of lower tops and lower bottoms. There are just too many headwinds that India and the world is dealing with at this point of time. You could talk about valuations, you could talk about risks around elections, you could talk about the geopolitical risks, interest rates, inflation, and with what global equity markets have done in the last 2 weeks. It's not been a good space. Look at the Russell 2000, it's at a 52-week low. The NASDAQ, which was the outperforming market, has corrected quite a bit. The reason I'm bringing these global points is because it's very relevant to India. Till a month back, it was just a party for Indian markets standalone, and everybody thought that this party is going to continue forever. But we live in a synchronized world. We have to move together. The trajectory, the trend is always together. There will be phases wherein India will do its own thing, which it did for about 3.5 months, but thereafter it's all got aligned, and now India's outperformance in the global basket, I think, is done and dusted. So coming back to your point in terms of levels, I do believe that this downtrend will continue for many more weeks to come. I do believe that this support zone of 18,850, 900 will break, and eventually it will take the index down to 18,400, 500, which is a very important support. And we will review there, not to say that that's the worst case and we will stop there, but we will definitely review there. And the problem is there are just too many levels on the upside that will act as a ceiling. 19,200, 19,400, very important resistance, and I don't see that being taken out. The only positive as I see is the domestic liquidity. The 16,000 crores coming into the system every month, that will in some sense protect the market from a collapse or a deeper fall. But barring that, I think the structure on an overall basis looks quite negative.
So the Nifty, a bottom to be reviewed at 18,500, it could go lower, but you would review there. Would your hypothesis about a top and or a ceiling be much more stronger? Would you believe that while you will review at 18,500, there might be a lesser need to review at 19,500 odd, if you will? Do you believe as of now that seems to be a hard stop if you as a ceiling?
See, I think in today's world, it's very difficult to look too much into the future.
That's true.
And any which way, I have not been in the camp of 5-year, 10-year investing, because I think 10-year plays out in a year. I think that's the world that we live in today. So I rather look at it a year at a time. And any which way with general elections, May 24, for me, my long term is a year, from at this point of time. But as you rightly said, I think 19,400, 500 for me is a ceiling, and only if the index moves past the same, then we will review. But there is a very high probability that the index broadly trades in a sort of a range. So the lower end could be about 17.5, the upper end could be about 19.5. And if we can just spend the next 3 months within this sort of a band, I think we've done well for ourselves.
Okay, so here's this chart. Nifty rebounds from the 200 EMA, but as Gautam Shah has now said, that there's a bit of a, how do you call it, a dead cat bounce or something that you saw, and very high resistances at different ceilings, 19,200, 400, 500, what have you. A very high probability of the Nifty breaking down all the way to 18,500, and a review post that. It may not necessarily be the end of the fall. The second question, therefore, and then I'll draw in some correlations. Gautam, you made this point about, I think, the US manufacturing index, and I'll come to that too. But first, at a point of time where the argument seems to be that the weakness is more pronounced than the strength on the Nifty, what happens at the broader end of the spectrum, mid caps, small caps, because those indices have had a far better run, and the flows of 16,000 also that we speak about are very pronounced at the broader end of the spectrum, both on the mutual fund side as well as, I think, on the PMS AIF side.
Well, yes, I think so. I think top quality will continue to stand out. I mean, if you look at the kind of money that's going into the top 100 in the large caps and the top 100 in the mid caps and small caps, those are the ones that will be protected. But anything that is grade C and grade D will be impacted quite a bit. So I think that's probably the reason this is a market where you have to stick with the industry leaders and the industry challenger. And let's not forget, we've had multiple corrections in the last 1 year. It's just that this correction has looked very different to any other correction in the past. Look at the bar quality, look at the momentum, look at the participation. In the earlier corrections, we were never really bothered. I remember 3 months back, you had that 1,000-point dip on the Nifty, but stocks were doing well. So people did not really feel the impact of the market correction. This time, people are feeling the impact because you have boys like HDFC Bank and Reliance underperforming, and how overowned this entire space is, from a money management industry perspective. And if you look at the kind of damage that we've seen in mid caps and small caps, I think that's also quite alarming. So there is no contribution. The problem is, how do I search for a bottom? Which is a segment or which is a stock that I can bank on to say that, okay, this is a pocket that can bail out the market. The banks are not doing well. They look like, underperforming the market. And I see another 5 to 7% downside, at least for the bank Nifty. So this underperformance is going to continue. Reliance seems to have lost its way, did not do well in the good times. L&T and ITC, I think, have done their bit. I think they were mega trends. I think they've played out really, really well. Other stocks in the FMCG space haven't done really well. So keeping all of this in mind, I don't see any leadership. And that's probably the reason I feel that the market will keep finding selling pressure at high levels. Mid caps and small caps definitely will be under pressure. And because they are slightly overowned at this point of time and anything and everything was getting justified a month back on the Excel sheets, I think it will all get corrected. So the big boys, the top quality names will definitely stand out, but anything that's not quality, I think will lose a lot of ground from here.
Okay. Viewers, keep in mind today's session, for example, Gautam made this point about how BFSI, and he mentioned banks, but BFSI per se looking weak. I mean, today's session is peppered with sharp cuts to that very pocket, starting with an M&M Financial, to an AU Bank, to IDFC Twins, to L&T Finance Holding, Shriram Finance, you name it. And I think you see a bunch of these mid-sized, non-Nifty names in the red today. Banks, you can argue, have had a fall already, but as Gautam Shah said, he believes there could be some more downsides to that. So that's part one done, Gautam. There's this wonderful correlation that I think in some fashion you were trying to draw, and please correct me if I'm wrong, to manufacturing as well. And we've seen those companies actually stand out for a better part of 2022 and 2023. Are you seeing some chinks in the armor?
Well, see, it's all good to be talking next 3 to 6 months and to be highlighting the headwinds. But to be honest, the manufacturing story in India and the real estate story and the infra story is here to stay. I mean, if I'm somebody who's only looking at 3 years, 5 years, and 10 years, I'm more than comfortable to hold on to these stocks and ride the correction. But unfortunately, speaking to a lot of people can't even handle a 3% fall on the index. And then they talk long term. So I think it's not everybody's cup of tea, but people who really can play the structural story should stay invested in these themes which I spoke about: auto ancillary, infrastructure, real estate, manufacturing. I think these are themes, real estate proxy stocks. This will do exceedingly well. So at any point of time over the next 3 months or till maybe the assembly election results, you get the index numbers on the downside, you get the support levels, and you start feeling that, okay, now the downside is limited, then I think you can see significant upside. I was just telling my analyst to look at the historic PE. Even though I'm a technician, he tells me that the PE currently for the Nifty is about 20.9, and if you really look at where it stands in the last 20 years of data, you would see that we are somewhere around the medium or just above average. So it's nothing frothy, from a fundamental standpoint, but from a price action perspective and the global world that we live in, and with all that's happening, in the world on the geopolitical front, that gives me the feeling that the market will start to discount all of this. What if oil goes back to 105? What if gold moves towards 2300? What if the rupee depreciates beyond 85, 86? All of these are risks. And then you cannot hang on to liquidity and say that, everything is okay just because money is flowing in.
That's true. Well, you spoke about the rupee. How high is the probability of a corrective move? I thought it was very high, part one. And correlating to that, and it's not a straight correlation. I know people make it very loosely that rupee depreciation, so IT companies will benefit. It doesn't quite happen that way as a 1:1 correlation. But are IT stocks coming close to an area from where we could find support even if they don't bounce back very, very quickly?
I think so. That's been our view, and that's been where we are committing into defensives. I think pharma and IT will definitely stand out. Pharma has done quite well in this entire 1200 Nifty point fall. And even if you look at IT, midcap IT has stood out really well. Look at Coforge, look at Persistent. I think they've all done quite well. And even in the large caps, a stock like TCS and HCL Tech, they have stood out in this fall. So in terms of relative outperformance, clearly it's there. And I think these are spaces where you can hide, you can commit into. Not to say that they will go up much, but they will not go down much. And on the rupee, for the last 3.5 months, it's been in this 2 rupee range. You might have seen 81 on the downside, 83.5 on the upside. And all along, I was of the view that maybe it will start to appreciate and the dollar will break down. Now, looking at the world, I just feel that if the rupee starts depreciating beyond 83.5, that will be a big problem, because we would be coming or snapping out of a range which has been in existence for the last 4.5 months. So another point that I will be watching closely. And not to forget global markets, Neeraj. Everybody talks about the domestic liquidity, but if you are in a global environment where equity markets in general are correcting, US markets don't have a good setup. I think the S&P 500 just witnessed a breakdown from a large channel which it was in for the last 6 months. Asian markets have not done well. We track markets like Hong Kong, Singapore, Taiwan. They've all seen breakdowns in the last 2 weeks. European markets were at lifetime highs couple of months back. They've seen a gradual turnaround from the highs. And we track some of the MSCI indices, the MSCI World Index, the MSCI Emerging Market Index, Developed World Index. Those indices have seen cracks in the last 1 month. So I think the world in general is hinting at a challenging period over the next 3 to 6 months. Can this get corrected very quickly? It is possible if the geopolitical situation improves and things get back to normal. But given the kind of ego that this world has at this point of time, it's quite scary, and I think it's going to impact financial markets.
Well, viewers, the key message seems to be that if you are risk off, it may not necessarily be a bad strategy. I mean, it seems from all the conversations that we've had thus far, and Gautam talking about charts now as well, that be careful. For all you know, Gautam, cash might be the king. It might not be a bad idea to sit on a little bit of cash to take advantage tactically at lower levels.
Absolutely. I think the best of names will come under pressure, have come under pressure. So even if you are 2025, even a 30% in cash and say a 10-15% allocation in gold and silver, I think it makes a lot of sense. And, let's not downplay the risks around assembly elections and general elections. It will be fiercely fought. We have seen what markets have done around elections in the last 20 years. And this time it just seems that it's going to get a lot more murky as we get closer and closer. Whatever the result, at least the market will be on the tenterhooks.
Makes perfect sense. Gautam, I have last one or two questions. One is, amidst all of this, the constant talking point has been the great manufacturing story in India. And those companies, even in this quarter, are largely saying that subject to the consumer preferences coming back, the story is alive and kicking. I mean, PLI, what have you, etc. I mean, and there are a lot of sectors that have gotten formed, right, in the recent past. There's this EMS sector, which now has 9 companies led by Dixon, but a clutch of others there. There's railways, which has now come to the fore. And today there was a news that there's a 4 lakh rupee overhaul being planned, so on and so forth. So some of these newer manufacturing teams, or even the erstwhile ones, do any of these look resilient relatively to any other pocket?
Yes, I think there are many names that look resilient and will do well, irrespective of the market behavior. But there are very few, and I don't think compliance allows me to take any names here. But in the manufacturing space, we do like a lot of stocks. In the real estate space, I do like a lot of stocks. Infra, I think, as I said, is a theme, and there are some stocks that could stand out. So yes, I think, see, these are long-term themes, and in a challenging global and local index environment, these are stocks that you need to pick on the downside. So we've kept our subscribers prepared that the moment we see that the index is close to our support levels, we've done our homework of about, say, 10, 12, 15 stocks, or sectors, which we feel will stand out over the longer term. The moment we are comfortable with the index, we'll go all out and look at opportunities there. In fact, even in some of the new age businesses like a Zomato, which I think I discussed with you last time as well, we remain extremely bullish. I think I see it as a 2 to 3 year story. And all dips should be used as a buying opportunity there as well.
And viewers, standard disclaimer, you have to do your own due diligence, own research before you try and act upon any stock that is recommended either by Gautam today or by anybody else, because these are not recommendations, these are views, and the views can change if in case charts or fundamentals change. So please keep that in mind. Please do your own due diligence. The guests are not responsible if indeed things change, and they are not on air to tell you all the time. Final question, Gautam, and something that you hinted at. You said it is a what if, but I'm asking you because it's a clear and present risk, crude prices. Now, usually crude is a big insider to what happens to geopolitics. And we kind of saw that the move towards 90 to 93 was indicative of something on the anvil, and something happened. Now, my question is, do charts indicate a higher probability of an upside in crude, or the other way around?
Well, I have studied these intermarket relationships for the last couple of decades, because in these books of technical analysis and fundamental analysis, there are some correlations which are put out, but the market ignores them from time to time. They just come to the forefront in very peculiar and abnormal times, and we are in one such abnormal time. Right now, I think that it's a lot more sensitive with gold and Bitcoin. I think these are the two entities which have done so well in the recent past, and I think are most sensitive to the global environment. NYMEX crude in general hasn't, done much. It's just been in a sort of a range, but the trend is clearly up. I think 75 to $78 per barrel is where the strong support is, and I do believe that there is going to be a move towards $105 over the next many weeks. So gold, crude, and Bitcoin all suggest that it's all heading higher, and therefore in that context equity markets might not do as well.
I think that's the headline for the story that we'll do on this conversation, viewers. The risk off factors are looking solid. The ones which cause macro concerns are looking like moving higher, and that probably is a telltale sign of the need for caution in risk assets. Yes, equities remain a great long-term story, but there warrants some caution in the short term. Gautam, appreciate this so much, you coming out and giving us all these vital signs at the start of the week. Thank you so much, and to you and your team and family, wishing you a great festive season.
Thank you, Neeraj. To you all as well.
Thank you so much, and viewers, thanks for tuning in to this edition of The Talking Point.